Hi everyone, welcome back to follow up, I guess, on our history of Japanese economic development. This is 2 weeks late because, well, I've been ill the past couple of weeks, and on top of a whole bunch of other work and personal matters, sort of deal. So yeah, I'm still a bit stuffed up, so please forgive me, right? Certainly, if you have any questions on what we are about to cover here, you can always write in, right? And yeah, so yeah, actually before that, just a couple of things. I think, whatever videos that we are making here, certainly we do it primarily with the aim of helping students who take general paper or H2 history in Singapore, but at the same time, from a practical standpoint, we also need to consider some things, right, which is whether or not all these things are actually bringing back any sort of yields for us, because after all, primarily we are still a tuition business, right? And yeah, so we will still continue to make content like this. The only difference is that I don't think we are gonna cover current affairs every week anymore. Instead, we will pivot more towards a case breakdown of big issues or big news or so on and so forth, right? If and when the current affairs call for it, as well as focusing on like content for H2 history or general paper as a whole. So you can expect in the next upcoming weeks some videos on things like how to write introductions, how to write a well-written essay, some tips and tricks, that sort of things. So yeah, but of course every now and then we'll still do like long form content like this. And yeah, so anyway, let's get to it, right? So where we left off the last time for Japan's economic history really was the point of time when Japan was really rapidly growing, and that unfortunately also brought with it many issues like what you see here, karoshi, right? But in the context of the H2 history timeline, since you guys will be studying the timeline up to 1991, it behooves us then to know about the eventual growth slowdown as well as the asset bubble, right, that occurred in Japan. The asset bubble that essentially preempted the rise of the lost decade from the 90s to in the 90s as a whole. So that was the period when Japan was facing just a depressed economic growth as a whole. All right, so there are a few things to consider here, of which I don't think I really want to get into too much detail, right? Because these are things that we may probably cover in another video someday. But what you need to know primarily is that in the 70s, right, following the Nixon shocks, we'll talk more about this when we do a video on the global economy. In the 70s, following the Nixon shocks, Japan came under many so-called voluntary export restraints by their allies, right? Basically, agreements for them to voluntarily restrain the amount of exports that they are putting out in the global economy. Okay, as well as the impacts of the oil crisis on Japan, because Japan at that point of time was importing about, if I remember my figures correctly, 99.5% of oil, right? Of all the oil that they use, they are importing 99.5% of it. The main impact really was that due to the oil crisis, as with the rest of the world, right? Japan experienced a huge, period, or quite a significant period of stagflation. So that's a stagnant economic growth as well as inflation of prices, right? And as a result, there were many sort of measures that the central bank took, right, in order to try and limit monetary supply, and that in turn had an impact on the subsequent, asset bubble that occurred in Japan. So that's the impact of external events on Japan, primarily how the government responded to it, and how that in turn led to changes within the internal system itself, right? Now for the finance system though, because now we are really delving into the nitty-gritty details of the domestic economy, what Japan experienced at this point of time was unprecedented, I guess, at least for the 20th century, unprecedented financial deregulations. So keep in mind that in a previous video, we talked about how the Japanese government ensured that the finance system in Japan was heavily segmented. So banks that offered deposit services, right? So like your typical deposit or savings account services, they would be barred from selling, financial instruments or services for that sort of investments. And likewise for securities firms, right? They would be allowed to sell certain, financial instruments for investments, but they are not allowed to offer, deposit services. So following the oil crisis, right? So the one in 1973 and 79, and on top of all the massive changes in the global economy at that point of time because of Nixon shocks and of course oil crisis and all that, what the Japanese government decided to do was to try and fund further growth of their economy. And in order to make sure that it had the funds to do so, the government started offering bonds. All right, so government bonds, okay, as you can see here in the 1975 budget. So what are bonds? Essentially, the easiest way to think of them, I'm not sure if I've talked about this in a previous video because it's been a while since I filmed those. The easiest way to think about them would be to think about them as contracts, right? So let's say, in fact, in real life, there are such cases also, even in the context of Singapore. So if the government is selling, let's say we use Singapore as an example. If the government is selling Singapore savings bonds, right, which is the government bond, the bonds that are issued by the government, essentially what you are paying for is you are paying for a contract that says that after this period of time, right, if let's say you put your money in let's say you purchase Singapore savings bonds about $1,000 worth, right, and you leave it there for about 10 years, each window when the government is offering the Singapore savings bonds, in the case of Singapore, and again this is a real example, they would provide you with a certain amount of compounded interest rates. So they'll tell you, maybe let's say at the end of 10 years, maybe you get back 4% compounded interest. So that contract essentially guarantees you your principal, that means the initial amount that you put into the bonds itself, as well as the interest that you would have accrued by placing your money in those bonds, so on and so forth, right? So of course you may wonder, like, what's the point of doing that then if you already have a savings like account with a bank offering pretty decent interest rates? Yeah, certainly. In the context of Singapore, and again this is kind of a sidetrack, but it helps us better understand what bonds are. Maybe some people may not necessarily have the best access, or may not necessarily qualify for the best amount of interest rates offered by a bank. Because if, let's say, I open a bank account with UOB, right? So things like UOB1, for instance, or I open a DBS multiplier bank account, they may entice you with, let's say, 4% interest rates. But to qualify for that, you would have to spend a minimum amount from the account, right? Every month, you will have to purchase insurance through the bank. So that means you cannot just if you want to purchase insurance through the bank, that means you deal with the bank rather than dealing with an insurance agent. You have to invest with that account, right? So invest in whatever things that the bank offers, or whatever things that you want to invest in, right? It's on a case-by-case basis. And finally, your salary has to be credited into your bank account. So your typical bank savings account, for instance, wouldn't work for people like me, self-employed individuals, because the way that I get my salary, so-called, is through a monthly invoicing system rather than a typical sort of payroll system that's offered by a company. Because I'm not employed by a company, I'm my own boss, right? And technically my bosses are my clients. They are the ones who pay me, okay? But I don't offer myself a salary, so-called. So as a result, I won't even qualify for a certain base rate, let alone the 4%, right? So that's why you have options like by options I mean like choices rather than the financial instruments options. You have options like Singapore savings bonds, okay? And what the Japanese government did at the point of time by offering all these government bonds was to sell all these bonds, okay, essentially guarantee through a contract that the people who purchase them, they will get a certain interest rates on top of their principal sum, so that the banks can get, not the banks, so that the government can have the funds to carry out its fiscal policies, its government spending, whatever that it wants to spend on. Or it can also be a way for the government to manage the total money supply in the economy. It depends on what the government is trying to do at that point of time. But at this point of time, for Japan, they were trying to fund, fiscal spending. That's why the government did that by offering the bonds. But as a result of offering these bonds, all the companies started to petition for deregulations. It's basically a situation like, hey, you guys are doing it, why not allow private companies to do it? And so that's how the financial sector started to deregulate even more and become less and less segmented. The problem, however, was that all these things were happening a bit too slowly for some of the banks, right? And many companies, okay, your private companies essentially, because now they could start selling their own bonds, right? They can get a source of funding without having to go to the bank anymore. So in a previous video, we talked about the main bank system, right? Like how a bank would anchor the entire keiretsu and all the other firms would go to the bank for financial advice and funding, basically, because the banks serve as a source of credit, so bank loans essentially. But if companies could now sell their own bonds, then they can raise funds on their own without having to actually go to a bank. And so what happened in Japan was that the so-called what's the word that I'm looking for? The strength of the keiretsu system started to waver, right? Because all the companies are no longer as reliant on all these banks. And because of that, that's why the banks would not have as much business as they used to have, and they were still adapting to the financial deregulations in the system in order to keep up with all the other companies that were, all the other financial institutions that were deregulating as well, right? These banks started to offer bank loans liberally, right? As with any financial crisis out there in history, it often can be traced to loans. Of course, how the loans build up in the first place is a different story altogether. But yeah, as you can see here, right, what the banks did was they would start giving out loans to customers that they previously wouldn't provide for. So if I were to use a parallel example, it'll be like your ninja loans in the 2008 GFC. In the context of the debt crisis, it will be all those loans that were given to Latin American nations, right, due to petrodollar recycling. Regarding those, I'll talk about those probably in another video. But yeah, in the context of Japan, that's exactly what they did. And the parallel here actually is quite scary in a way, because this is similar to what occurred in the AFC, right, in 1997. So for students that are studying the Japanese economic history for H2 history, AFC is somewhat removed from your syllabus, but for the students that offered the old syllabus, they had to study that. And of course, the specific context differed between these two crises. In the case of Japan, it came as a result of many years of rigidity in the financial system, and then when the deregulations occurred, all hell just broke loose. But in the case of the AFC, it was a question of just poorly planned monetary policies that led to the build-up of debts. But the parallel here is that all these banks started offering all these loans. Companies started taking them willy-nilly, and in the case of Japan, much of it went into the financing of all, as you can see here, all the urban projects and rural projects, right? So much like AFC, much of the funds or much of the loans that were built up by the companies in Thailand went into commercial property. And obviously from a business standpoint, all these leisure destinations, it is very number one, the upkeep is obviously very high. Number two, your margins are very, very razor thin as a result of that. So and not only that, it is fundamentally a leisure thing. If we look at it from an econ standpoint, right, it is price elastic, so and obviously very recession sensitive, right? As you can see what I wrote here, right, which is based on the readings that I read, all these things that were built, all of them went bust, i.e. they all went bankrupt, except for Disneyland, obviously. So that's not all, right? The banks also gave loans to all these financial institutions called Jusen, right? And they dealt with mortgage loans. Once again, it's a very familiar story, right? And what they did was they started to offer high-risk subprime loans to clients that were referred by the banks for a finder's fee. Oh, yeah. So this part here is pretty much the same story that occurred in the 2008 global financial crisis. It's kind of morbid in that sense, but basically what that meant was that typically if a bank were to provide a loan, right, to let's say people who wanted to purchase real estate or people who wanted to purchase a home, they will look at a couple of things, right? I mean, obviously most adults would know this, but since this video is targeted towards students, right? If let's say you want to purchase a house, you have to take a loan, and before you take the loan, the bank will assess, number one, whether or not you have a job, obviously. Number two, what are your income levels, so you actually have to disclose those information. Number three, whether you have had any delinquencies in the past, right? That means, have you bankrupted before, okay, or do you owe any sort of debts at the moment? And of course, again, it is on a case-by-case basis. It depends on how much you are asking for and what you are intending to purchase. But typically, when you want to purchase big ticket items and you take a loan, the banks will assess all these things. So what we call subprime loans, in short, would be loans that are given to people with poor credit rating. Maybe they don't have a job, maybe they have low income. Low income means lower likelihood of them being able to service their loans. No job, obviously they can't do that. Maybe they have had bad debts in the past, right? So maybe they have defaulted before on their loans. Maybe they have declared bankruptcy before. But a loan is still given to them, and as a result, this loan has a much higher chance of failing, right? That means there's a much higher likelihood that whoever that took on this loan will not be able to repay the bank. That's why they call it subprime. Okay, the Jusen essentially offered a lot of all these subprime loans, right, to clients that were referred by the banks. So what that meant was that the bank, they decided, hey, they can't provide a loan to this person, this particular profile. Then they will refer that client to the Jusen, and then the Jusen will be like, okay, no worries, I will lend you the money. And in return for that, they make money on the fees that are provided by the banks. But I think you can see where this is heading already. If so many people are taking on subprime loans, if all of them default at the same time, then the entire system comes crashing down. And that's exactly what happened to Japan. And in fact, in the 2008 global financial crisis as well, which led to the collapse of the housing market and eventually, the global economy, right? So by 91, as you can see some stats here, non-performing loans, that means loans that were being defaulted on or were just not being serviced, was at 4.6 trillion yen, 38% of the portfolio of all the Jusen in Japan. So 91, when this bubble burst, obviously, the property prices would fall, right? That's why it's called a bubble burst. A bubble because all the prices are rising, right? And when it bursts, everything will come tumbling down. So of course, from a historical standpoint, that's what happened to Japan, and what immediately triggered the lost decade, which in reality stretched into the 21st century as well. But from an economic standpoint, so again, for students that take econs on top of H2 history, you have an advantage here, but the idea is very simple. If loans or if credit are so readily available, right, that means you can very easily go and borrow money. What that may cause, and indeed that's what happened to Japan here, is that people may go and borrow the money and then they'll use it for certain projects, like let's say residential project or a commercial project, like all these theme parks here, okay? And what that would do is that would drive up land prices, that would drive up housing prices, because people are just yearning to go and purchase all these big ticket items so that they can either convert it to a sort of like source of income through rental, or they hope to flip it for a higher price afterwards. And as a result, quantity demanded increases, price drives up, and that's what happened to the asset prices in Japan. I'm not sure if I have the figures here, but yeah, there we go. You see, land price index 90 in 1984 to 150 in 1991. So it's almost 100% increase in a span of 7 years. And commercial land price went up also about almost 100% increase. So when that occurs, right, the prices of all these things just kept increasing, which also means that the amount of loans that you would need to take to purchase more of these assets would be higher, because you need to borrow more money. But if so much or so many of these loans rather were given out to clients with high risks of defaulting, if all of them default at the same time, you are talking about money disappearing overnight, because they will have used that money and they will have used it to purchase all these assets, and the money is locked into those assets already, right? Because you have already spent money on the contractors, on renovations, so on and so forth. And prices were artificially increasing due to increasing quantity demanded. So if the economy were to come crashing down, right, and all these people defaulted on their loans, certainly, the banks can foreclose on these properties. That means the banks can seize them in return for the, as a consequence of the defaulting of the loan. But the bank would not be able to convert that into cash, because who the hell is going to buy from you at a time when recession is happening, people are losing their jobs, incomes are lowering, right? And the prices of all this land would come tumbling down, because the quantity demanded would almost like violently shift towards, shift towards the left. Yeah. So yeah, that was the story of Japan in short. So if I were to summarize, essentially the best way to understand the Japanese economy was that they had this system in place that very deftly utilized the culture that's inherent in that society, building the Keiretsu system while the government set the direction. As a result of that, it will come to experience a lot of socioeconomic changes, like population changes. So aging population, for instance, right? We have talked about this in one of our podcast episodes. Things like karoshi, as we mentioned in a previous video, and of course the rise of cram schools. In Singapore, they are called tuition centers. So people like me, right? Yeah, it just seems like I'm undermining my own point, my own business when I say that. But yeah, of course they would also experience cultural changes. So let's say increasing some right opportunities for women as a whole, although the gender sort of like disparity in Japan, based on their culture at the moment, is still quite bad in that sense. But yeah, there were all these socioeconomic changes as a result, right? But the most significant of it would be the increasing sort of, I guess, complacency, right? Okay, I shouldn't say complacency, consumerist behaviors that led to a lot of the overborrowing and overspending in the context of the asset bubble. So yeah, that's Japan's story. And if you are interested in finding out more, certainly you can go and read up more. As you know, now in the 21st century, they are no longer the second largest economy in the world, even though they managed to achieve that in 1970. They are now the fourth largest economy in the world. Whether or not they would make a comeback, honestly, I don't know, unless some things change. But yeah, so yeah, that's Japan's story. All right, Japan's economic development, and I think that will be that for this week's I guess a podcast episode, because we are still ideating some things about the content. I don't think we are gonna do any more current affairs stuff already, because it's just doesn't seem to be the best use of the very limited resources that we have. And yeah, anyway, regardless, I hope this series of videos on the history of Japanese economic development was helpful. If you have questions, do certainly drop us a question using this link below, https:// the discourse-education.com/discourse-education-podcast, or simply go to our website, right, and look for us there, right? Look for our contact details there, and follow us on our socials. And if you are looking for a free trial for H2 History Tuition, please do not hesitate to contact us. We offer a free trial lesson, 0 strings attached. I.e., if you choose to continue with us for the long term, we won't charge you for that trial lesson. So yeah, that will be that. Hope you learned something from this. You can look forward to more H2 History videos in the near future, and I'll see you guys next time.